65 to 70. But if you live beyond 70 and no income is coming in, you now know that the income you have when you are younger is very, very relevant to your life. And the only way to make it relevant then is to make sure that the best financial decision is taken over now. Now, as we are speaking, it may be less to some people, but however, it's better than nothing. So, knowing that annuity is one of the things that can give you income stream for life, it means that you have to, why not venture into it? You have some money, keep somewhere that is actually there, baptizing your bank, making your bank look good. I don't think somebody will win any prize by having big account, having money in the account big enough to. I don't think there's a price attached to it. Whenever you open your account, your bank account, statement account, you see hundreds of thousands. I don't think there's a big price for it than using that money to prepare for your future. So annuity is one of the things that can give you income stream for life. So if you have some money keep somewhere that is not using, it's not an emergency fund. Don't touch on your emergency fund. Money you just keep somewhere is breathing without dying. The money is breathing there. Just take it, go and open an annuity. Open a fixed index annuity. 10,000 can do that. 20,000 can do that. 30,000, 40, 50, even 100,000 can do that. Open it and call it some money just keep somewhere. Remember, in annuity, you will participate in the gain, you do not participate in the loss. I told you guys in the morning what happened to the 401k I have. I get up from my job November. I was wasting time in doing the annuity actually. I suppose I've done it that November. But I said, I will. So my daughter came back from um, holiday for Christmas holiday. One day she asked me, Daddy, have you rolled over your money to annuity? I said, oh, I will do that. She started it. My daughter started doing it. And I have to join her to make sure that it's done well. So I suppose sign a paper, which I have not signed. Yesterday, that was yesterday or the day before yesterday. Today is Wednesday. On Monday. So that paper, I needed to get an account number from the account officers, those who are managing the 401k. You know, your 401k always have managers who you pay. Whether you are losing or you're getting, you are paying them. I hope everybody knows that. So I log into my account. Behold, I'm losing close to $2,000. I was, I was so mad. I was so mad. My daughter was laughing at me. Said, Daddy, you would have done this since. Because when the funny aspect of it, when we put the application, the amount estimated we put the application is what we see there. But on Monday, when we want to get the account number to give the annuity company, the insurance company, behold, the amount we're supposed to put on the Roth IRS Roth side of the annuity of money rollover, the money, I mean, not on the Roth, on the 401k, the money was down by 2,000. So imagine how it is to every other person. Imagine how it is to those who don't even log into their 401k to know how much they have. There are some people in this call now, as we are speaking, have not one day login. let's be sincere to ourselves. Who have not logged in? Just be sincere to yourself. Have you logged into your 401k one day? Let's just be sincere to ourselves.
Yes, I do.
Who have not logged into his 401k, his or her 401k? You can't tell me that all of us is logged into our 401k.
Yeah, I've logged in.
Huh?
I said I have logged in.
Yeah, some people have not logged in. So it's good that at least we are logging in to see how it is, how it's performing. Yeah, it's a good practice to log in to know how it's performing. So as you should log into your if you have insurance policy, equally log in and see how it's performing. Then if you have annuity, of course, log in the way you log into your account in the bank to check, always log in to check your annuity, check your 401k, check your life insurance policy,
I'm
how
just
they are performing.
listening now. It says I'm 76% almost there. 76% almost there.
Are you speaking to us?
Yes, I say I've just logged in now
Uh-huh.
to
All
see
right.
what is going on.
Yeah, log in. When you log in, the last time, what was the last time you log in?
I'm just logging in for the first time.
Oh, for a yes, I like the confession. I like the confession. So please, let's make it as a duty. Log in, always log in to check. That will prepare you to take a decision based on it. Most especially in some job, there are some of us who left money somewhere in their previous job. They left the 401k they accumulated over there. They don't even know how to get it back. There are some people who, among us, who are like that. In our community, a lot of people are like that. Where they left their job previously, they don't know that they accumulated some 401k and they left it there. They don't log in. They don't check. So such money where you have left your job somewhere, the best thing you can do to yourself and for the future and for a retirement benefit is to roll that money that you left in your 401k in a job that you're no longer working. You left the job, roll it over to annuity immediately. Don't waste time. But you cannot roll over to annuity where you're working now. A 401k of a job presently where you are now, you cannot really roll it over because it's still accumulating for you. So you cannot roll it over, but you can roll in your previous job. Why I could be able to roll my own over because I have retired from that job. So if not, you cannot roll it over. You only roll over on a 401k on a previous job where you are no longer working. I know some of us have worked 2, 3 jobs. Gather them together, roll it over, and put them into annuity. However, since
So I have a question on that.
hmm,
So when you left your previous job and you want to roll over that money, are they going to take out taxes, right?
no, 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 no,
Oh,
no,
they not? Okay.
no. They will not take any tax. It will be like you are rolling it over from another account to another account. You are not taking anything out of it.
Okay.
However, you can only qualify to take it over when you are qualified to take it out as 401k, as a 401k. So
Okay.
it's the same taking it out, the same withdrawal method. That is what it is.
All
But
right.
however, the good thing about it is this: in as much as you are losing in 401k, in as much as you are paying some managers you don't know who they are, in
Mhm.
annuity, you do not pay nobody. You are
Okay.
taking risk by yourself. You are not losing any money. You only participate in the gain. You do not
Okay.
participate in the loss. So you can see the difference, the mass difference. So check your previous job. Let it be one of the things everybody get today. Check your previous job, roll your money over to annuity. But where you are working presently, you cannot do that.
Okay.
Yeah.
Thank
So,
you, sir.
oh, you're welcome. So the insurance company is a legal entity that what underwrites and issue the annuity. Who give us annuity is insurance company. However, there are 4 parties in insurance and annuity contracts. We have 2 parties in life insurance contracts: the applicant or the insured and the insurance company. 2 parties in insurance contract. Remember, the beneficiary are not part of the parties in what? In insurance contracts. The 2 parties in insurance contracts are the insured and the insurance company. Are the 2 parties. Now, in annuity, we have 4 parties in annuity. One is the insurer, which is the insurance company. The contract owner, which is if you are rolling over here or you are the contract owner. Then the annuitant and the beneficiary. The annuitant is that person who can withdraw money from that account. The Contract owner can also be the annuitant and your beneficiary. They are the four parties in annuity, unlike in the life insurance where you have two parties. Now, the insurance company is where you can do your annuity. You know the good thing about annuity, doing annuity life insurance company, you as a person can do your own annuity. That's the good thing about that. I hope everybody knows. You can do your own annuity.
Okay.
And you see the good thing about it, the annuity company will pay you commission for doing it. So some of us just leave money, we leave money on the way, you know. Some of us just decide to leave some money on a track. You can pass your license, get your license done, do all the requirements. Let it be the first policy you write. Do your annuity, trust, roll over your annuity. I will teach you, I will show you how to do that. You get the commission, you will get the commission. You know, you get the commission. It becomes your first business. You can do it by yourself.
Okay.
However, you cannot do it without a license.
Okay.
So that is the good thing about it. Or otherwise, you can tell the person who introduced you, your business partner here, you can tell the person to assist you, to help you, or even to help you do the annuity. But it is very, very important. In 401k, you are paying somebody 2% of your money. The person they call the manager. You never see the manager before. You don't know who the person is. Whether you are losing, just like I lost money, somebody who is there receiving a condition, driving his seat left and right, is there, I'm paying the person, whether I gain or I lost. They don't care. Hello? All right. So, yes, just like I was saying, anybody who's your business partner can help you do that, you know. Anything concerning finance is a personal decision, what you want to do. However, doing what you want to do with the education, even when you get your license, the education you're providing to the person is to make the person take an informed decision. You're not going to tell the person, look at what you're going to do. No. Look at what you do. No. You're only going to help person to make an informed decision. If you're writing life insurance policy for somebody, you're not going to choose for him. Please unmute yourself when you are not speaking, please. So if you're writing life insurance policy for somebody, you will not tell the person to do this or do that. You teach the person, give the person the knowledge, let him make an informed decision. So that's basically what it is. Your annuity, your life insurance, your 401k, just do the right thing that you know that will be to your own benefits. Just do the right thing. You will not tell the person to do this or let the person do the right thing that you know that will benefit him. So we said we have 4 people that are involved in annuity, the 4 parties in an annuity. We stay, one of them, the insurer. Who is the insurer? Whenever you see insurer, is the insurance company. The contract owner is you who decide to roll over your money or who decide to use your own money, which you have paid tax on before, to write an annuity policy. Then the annuitant is the person who is going to get the payouts. That annuitant can be you. And again, you now have the beneficiary who is going to receive any benefit in case the contract owner or the annuitant is no longer available. Then in the life insurance, we have 2 parties to a contract. The insurer, which is the insurance company, and the policy owner or the insured. When the policy owner is the insured, then he or she is party to the contract and the insurance company. So you can see the difference. Now, let's look at in insurance companies. It's only the insurance company that can do annuity. And you be an agent, a producer, or field underwriter can write annuity and life insurance. But you must know that annuity guarantee what? Income for life. Then the contract owner is the person who buys the annuity. If you buy the annuity, you become the contract owner. As the owner, you have control over the contract. You can decide what to do with the contract. You can decide when you will annotize. You can name it. You can change beneficiary. You can do cash distribution, and you can do transfer of ownership. In life insurance, when you are doing transfer of ownership, what do we call it? Can somebody remember?
Say that again.
In life insurance, if you want to transfer ownership, what do we call it? There's one name for it.
Assignment.
Assignment. Yes. In life insurance, you don't say it's assignment, which means you are trying to transfer you being the owner of the policy, you transfer the owner to another person. You assign it to another person. In life insurance, it's called assignment. Now, the annuitant, we have known that the contract owner is that person who buys the annuity. You can buy annuity with your ordinary money, the money you have paid tax on. You can buy annuity with it. The money is saved in the bank. You can use part of it to buy annuity. It must not be a rollover from your previous job, no. You can use your ordinary money you have somewhere to buy annuity. Let's assume you decide to use 30,000, 40,000 to go and put in for annuity. You know what you have done for your retirement? You have reduced the problem by at least 1/4. So it's a good decision to do. So if you have the ability, please do it. Pass the exam, write the annuity. Then the annuitant is the person named in the annuity who received the income benefit when it is annotized. Remember, when we say annuity has been annotized, it means accumulation phase has ended. Now you begin the payout phase. I hope everybody remembers that.
So annuitization is the same as a payout.
Correct. Correct. Accumulation, in annuity, we have accumulation phase and annotization phase. The accumulation phase is that period you are paying money to the annuity. Then annotization period is the time you are paying you. Let me use the word, you are withdrawing money out of it. There's accumulation phase, there's annotization phase. Annotization phase is when it begins to pay out. You cannot do a payout until accumulation phase ends. What that means is this. Let's assume you write an annuity that is 10 years. For 10 years, you are required not to annotize until what? The
10 years.
accumulation phase end. When will the accumulation phase end? That 10 years. However, let's assume you are pressed with something you needed money, then you can go and take money. But however, you're gonna pay penalty for that. You're gonna pay a little penalty for that. So that is the way of holding you accountable to make sure that money is kept for what it is meant for. Definitely, the money in annuity is meant for your retirement. It's meant for your retirement. So when annuity contract is what? Annuitized, that is when the payout starts. The age of the annuitant is taken into consideration. Who is the annuitant? That person who benefits from the annuity.
So
Sometimes the owner of the contract cannot be is not the annuitant.
okay, that's a question I wanted to ask.
You can decide, you are the contract owner, you can decide you are not the annuitant, your child is an annuitant.
Okay.
Then upon that, you can still say, the other person is the beneficiary. However, the contract owner can still be the annuitant. You understand? Because the
Yes.
contract owner can decide to be annuitant, so he can receive the benefit from the annuity when the big payout starts.
I'm hoping.
Yeah. So when an annuity contract is annuitized, the age of the annuitant is taken into consideration. Of course, the purpose of annuity, more especially, is for your retirement. In designing the annuity, it can make it to be income for life, which means you'll be receiving income until the person passes. You can make it, we can say you want to receive the lump sum from so age when the accumulation phase ends. So depending on what you want, you can decide, say, I want every 2 months to be paid 1,000, 2,000, 3,000, 4,000, depending on the number, how much the
amount of money,
is.
yeah.
Yes. So annuity is the best thing you can do to save for your retirement. And one thing about it, unlike every other portfolio, you are not participating in the loss, you only participate in the gain, more especially when it's fixed index. So there's nothing stopping any of us to go and do it. With little money you have, you put in a bank. I keep on saying, don't be like that lady. I've been talking to that lady since at the point Dr. Ruth has even presented to her. I talked to her, me and she was working one place before I quit my job. I talked to her. Every time I spoke to her, what she would tell me that, look, she wants her money to be where she'll be seeing it every day. I asked her one day, so do you think you are seeing your money? You have good money in your account. Go and tell your bank that you want to withdraw $30,000 or $50,000 at a go. Let me see what they will do. They're going to ask you, what do you need it for? They're going to give you an appointment to come back. When you come back, they take you to an inner room. They ask you question. They will think
But they want to be using the money to do their business.
Of course. Of course. They will ask you, they will do as if they are protecting you from being
scammed
from
or
being
wasting
scammed.
it.
But however, that is not the intention. The intention is that you are moving the money out of their pockets. So I think our people begin to understand this fast so that all of us will retire smartly and happily. There's no need you getting out of job after 40 years. Any small problem, the person will roll over to nursing home. Why? Because the main reason why people go to nursing home is because of what? There's no money.
Or lack of planning.
Yeah, which comes to lack of planning. Go to nursing home is because there's no money. Believe me, if you have money, you can pay off your home. You can be able to, while you're even sick, you can be able to be paying the yearly tax when you must have paid your home off. And you can bring, even if the children say they don't have nobody, they are not available, you can bring someone to take care of you while you are alive.
Yeah.
So it's just because no money. Then they say there's nobody. This excuse will be, there's nobody to take care of him. We are not always available, so we're going to take him to the nursing home. There's no money. So sometimes we're going to tell ourselves the truth. So the annuitant can be you, the contract owner. you can equally appoint some other person to be the annuitant. That person, the annuitant is that person who is going to collect the benefits.
So is it wise to use the beneficiary or annuitant interchangeably?
Of course, remember, as a contract owner, you can make any changes to your annuity. However, there are some changes you make, the company may know why, because remember, this is a contract. Just like in life insurance, when you, after they make the offer, the insurance company accept the offer, they now give you a counter offer, you finally sign it, the contract is now binding, you can no longer make changes to that contract. But in terms of changing the beneficiary, yes, of course, you can change your beneficiary. But there are some changes you may not be authorized to do. But in terms of changing beneficiary, yes, you can.
This is one of the dangers of getting or signing a policy before getting into a class like this. When there are certain things you said, and then I will start wondering if I had done things right. I had a IUL and one annuity account like that. And I wasn't sure actually if everything was done accordingly, knowing what I am hearing now. If I had had this knowledge prior to then, maybe. But I think all is not lost,
No,
because
it's not.
I have people like you now. I can
It's,
say,
the thing
okay, let
is,
me bring the account so you can
yeah,
look
it's
it.
not late. It's not late. When you get the knowledge, you can review your own policy. That is why
Yes,
if you get somebody who write your policy, the goal is for you to know the laws that govern what you have. I think that's the best thing that can happen to anybody. Apart from writing the policy, you want to know how your policy works.
yeah. And as you were saying, there was something they sent me after the premium was sent and everything, and they brought what I wasn't expecting or I don't even know what it is. I just read and they said sign this, write this, and bring back, and I did. So but that's why we are here learning.
No. You see, you get it through. Let it not be. It's not very regrets. Let me tell you the truth. You know
It's
why
good.
it's good? It's even good to be led than not to not to do
Yeah,
at all. You see, let me tell you, you see that your policy, I give you in the next 6 months. In the next 6 months, you can bring here a policy and dissect it
yeah,
and know what it means. If there's any
that's my plan.
correction, you can do a new one to correct it, make it perfect to what you want, to what suits you. Of course, that's why we say we educate our customers, our clients, to be able to make an informed decision.
Yeah,
So
sometimes.
you being the educator now can be able to bring your policy, scatter it, and know what it means, where it leads you, whether
Yeah,
even the policy you made, the life insurance policy you made, did you make it more of protection side or more of accumulation side? Those things is what you're gonna know with time. So you are the good thing is that you are here and you are here.
yes.
That's the truth. But for some people who do not know the benefit of what you are doing right now, if you talk to them, they will tell you that it's a scam.
Oh, yeah.
They will tell you that it's a scam. Why are you wasting your time? Those people who believe they know, why, but they don't know nothing, they are the people that in time, you will turn around to laugh at them. Because definitely it will hit. There is no way it will not hit up. There is
Okay.
no way. Forget this thing we are doing. There is no way you cannot know how to organize your finances that it will not affect you for life. There's no way. There's no way.
So we have here, if no beneficiary is listed on the annuity contract
Mhm.
and the owner dies before annuitization,
Mhm.
the proceeds are paid to the contract owner's estate. What if the person doesn't have an estate? Now, I know I'm not thinking about house. When you do wills and all that, you have a plan estate, but not everybody have that. So if one doesn't have an estate and
right.
dies, what happens?
Let me tell you.
Okay.
When you say an estate is already something is already created. It's already
Under
created.
what?
Let's assume, you know, what we call estates
Mm-hmm.
is your bills. Those bills you have when you are alive is called bill. When the
Okay.
person passes, all those bills now become an estate. Did you get
So,
it?
okay,
When,
so it's
when somebody, you know, and now you are paying your mortgage, you are paying a student loan, you are paying all those hospital bills, all those things. They are called bills now that you are alive. When the person is no more, those bills now turn to be an estate. So let's assume that person does not have any beneficiary. They will tell you that this account is going to an estate. Yes, estate. Yes, it goes to an estate. When it goes to estate, the next thing you do is to go to probate courts.
so if we say one of the reasons we do this annuity and IUL, right? They are the two what were you how you but two of them does not go to probate, right? Is that true?
If you have life insurance, one, you don't have any beneficiary. Two, you have an underage beneficiary. Yep. If the person passes, the benefits go to an estate.
Okay, so
If you have annuity, you do not have a beneficiary, the person passes, it goes to an estate.
okay, if it's an annuity and then the person doesn't have a beneficiary and he goes to the estate, will there be a need?
Hold on, let me come in there. Even the money you have in your bank, if you pass, there's no beneficiary written on that account, it goes to an estate.
I know that.
All right.
Yeah.
So
So
everything the person have while that person is alive, if
Hold on.
the person
Hold on.
passes and no
Hold on,
benefit.
engineer.
Uh-huh.
Dr. Sonia,
yeah, my dear, how are you,
I'm
Doctor?
good. So annuity product,
Yes.
you can never submit annuity application without beneficiary.
Yeah.
So it can never happen. That
Okay.
policy will not be complete. So
All
your
right.
beneficiary could be human being, it could be trust,
That's the word.
it could be animals, it could be whatever. But it can never finish annuity or life insurance application without beneficiary. Okay?
Okay.
All right.
All right. So Dr. Ruth, thank you. So the beneficiary is the party specified in annuity who receive what funds.
Honey, hold on. Honey, hold on. Who have iPhones? I took you out before.
I think that should be
If your
Mary.
name is not on the screen, we'll take you out. So who have iPhone? Who are the iPhone people? There are two of them here.
I think one should be Mary.
So
Mary, are you here?
you can rename yourself, but I will not accept anyone with iPhone without their name on it. No. Okay. So please rename yourself, or you can exit. Okay.
Who with two iPhone? Who has two iPhone? Who has the two iPhone?
Are they?
All right. If I think that is Mary.
I'm using one. I'm at work.
Who is that?
Clara.
Oh, Laura, all right. But you
Clara.
can, yeah, you can, Clara, you can change it to put your,
Yeah.
you can rename your own, just rename it, put your name there. You're welcome. Today that you join us, you're welcome. Then who again?
Working.
There is one other person Who has one iPhone? Yeah, Clara, good. You change your own, good. Then who have another one? We want to know who is there, so we know we are speaking to. I think that's the right thing, everybody. Who have this iPhone? I think the person is out. All right, the person is out. So that person is not supposed to be here. You see? I think I don't wanna, if we lock the Zoom now, somebody might like to enter. The person can no longer enter. All right. All right. So the annuitant, we have talked about the annuitant. The annuitant is you. The owner can be the annuitant. The beneficiary is the person you specifically keep there in case the death of the contract owner. Remember, the contract owner can be the annuitant. So in case the contract owner passes, the beneficiary is always there to collect the benefits. However, if there's no beneficiary, definitely it's going to your estate. And when we say it's going to your estate, it's going to the probate court. What's the reason why it goes there? Because they're going to use it to pay your bills. Remember, you have bills. After all, you have not paid your tax before the person passed. You still have to pay your tax for the year. You're going to pay your tax until the point the person died. So you are still owing Uncle Sam. Of course, you know that.
I thought if anybody died, their bill is over.
Who told you? You mean those people who took the person from the bed to the morgue? They're not gonna get their money. They're gonna be paid. The car that carried the person to the cemetery for burial will not be paid. Is that what you mean? The doctor that treated you before the person passed will not be paid. Is that what you're saying?
Ooh, life.
No. Even the tax for the year you have not paid, you're gonna pay them. Of course, you are owing students. You are owing students. You are owing a lot of things. It's gonna be paid too. Your monthly bill you have not paid in that month because of sickness. You think that electricity company they will leave you? You're gonna pay them. Those are bills when you're alive, so they'll be transferred to be your estate when the person passes. So whatever money they accumulate, they get from your estate will be used to settle those people. So that is the essence of going to probate court. So after settling your people, whatever remains comes to your beneficiary if you have one. Or otherwise, it goes to the state where you live. All right. So an annuity is considered an insurance contract between the contract owner and the insurer. This is just a summary of what we just talked. Who is the insurer? The party issuing the annuity. The insurer, that is the insurance company. Who is the contract owner? The contract owner is the person who purchased and paid for the annuity. That person, remember, that person can surrender the annuity. He can execute non-forfeiture option and name a beneficiary. You have so many rights because he's the contract owner. The annuitant is an individual who receives the benefit or payment from the annuity. The annuitant can specifically be somebody else. Then the beneficiary is the person who comes out when the contract owner is no longer alive. It can be different from the annuitant. It can still be the same as the beneficiary. The annuitant can be the same as the beneficiary. But the person who is the contract owner can be the annuitant. So if you are the annuitant and you're the contract owner, definitely you cannot be the beneficiary. The beneficiary will come in when the contract owner is no longer alive. Now, we talk about the beneficiary is a recipient. That person who received the annuity asset is the annuitant estate. If it can be your estate, it can be maybe would you call it will? Whoever you choose, you can even choose to go and give it to your community. Your community can be your beneficiary.
That's true. If they are named, right?
Yeah, if you name them as a beneficiary, they become your beneficiary. You can name your church as your beneficiary. You can name your pastor as a beneficiary. So that's what it is. You can name your caregiver as a beneficiary. You can name anybody as a beneficiary.
So what is this non-forfeiture option?
A non-forfeiture option, we're going to see it as we move ahead as chapter 4. When
Okay.
you on life insurance, that's life insurance, non-forfeiture option is that, for instance, you have a cash value life insurance. The part that goes to your cash value is a non-forfeiture which you must receive, if you like. So it must be paid back to you. The
Okay.
sum of the parts that goes to other charges, you cannot, those ones have gone. The one that belongs to you is the one that goes to your cash value. All right. So annuity classification, look at where annuity get messy. This is where people get confused. So I want everybody to pay attention. This is where everybody get confused in annuity. This is where it get confused. We have 5 classes of annuity. This is where people get confused on it. Please just pay attention to this one, what we're going to say now. One is annuity can be classified in several categories. You can classify annuity based on how the premium are paid. Remember, this premium can be paid as a single premium. It can be paid as a flexible premium, which means when you say single premium, means one-time lump sum payment. Just as you want to write an annuity of $40,000, you go to your bank and get that $40,000, put it in lump sum, put it one time. That is a lump sum payment of annuity. You have paid it, you have paid it. You're not adding any money to it. Of course, you can decide that, look, the payment of this annuity cannot be single premium. That is lump sum payment. If you want to make it flexible premium, which means you want to pay it multiple times, over time, over and over. Somebody asked that question in the morning. Can somebody decide to be paying in money to his annuity? Yes, of course. We want to make the payment to that annuity a flexible premium, which means you can pay it multiple payments over time. Remember, the only thing about it is this. When you pay multiple times, it means that you are extending the accumulation period. Let's assume somebody who paid a lump sum, one-time payment of his annuity, today the person paying $40,000, and the other person said, the $40,000, I'm not going to pay it for once, I'm going to pay it gradually. Who do you think will have more accumulation?
As in who
Isn't
have
it
more money, right?
Yes.
Is the single premium and lump sum?
The lump sum person,
Yeah.
because he will start getting interest immediately. But this other person, as he pays in the multiple payment, so as the accumulation goes. But this other person has started, the person who paid lump sum has started getting interest from his accumulation.
Question, sir. Does this also apply to premium for life insurance?
Correct.
Okay.
So that is why, yes, it's good to ask that question. That is why most of the agents will tell you that the best thing for you to do to your policy is to pay annually. If you write policy, they must have told you that you pay annually. That's one of the reasons. If you pay your policy annually, it's better than when you pay monthly. And again, when you pay annually, do you know you pay less than when you are paying monthly? I hope everybody knows that. If you pay annually, you pay less than when you are paying monthly.
Yes.
If you're paying, let's use your auto insurance as an example. You know, all insurance is a contract, it's almost the same thing. When you are paying your auto insurance and you are paying monthly, maybe the agent will tell you, say, look, pay 6 months. If you pay 6 months, pay so amount. If you pay 1 year, pay so amount. You now decide, say, no, I want to make it easy. I'm going to pay monthly. You are paying more than required. Because at any amount you pay, at any premium you paid, there must be a charges on that premium. Administrative charges must be applied. But you decide to pay annually, which means they're going to do it only once. So the administrative charges will be less. Thereby, reducing the money you are paying. So you are encouraged to pay your policy annually. But does that mean that you cannot pay monthly? You can. But however, for your own good and for the policies to do what you you want the policies to do, and more especially now that all of us have almost come late. Now that all of us are almost come late. In all of us here, I don't think anybody is below 20 years. You don't laugh. That is it. We are telling ourselves the truth here. All of us are almost come late. So the earlier you pay, the better. If you decide to pay annually, that will be good for you. That pay monthly. It's good for you. So the agent will always insist that you pay annually. Yes, it's for your own good. Now, we have classified annuity based on the way you pay your premium, how premiums are paid. We say the premium can be paid in two ways. One, as a single premium, that is one-time lump sum payment. And two, as a flexible premium, where you can pay multiple times over time. Now, the another classification again is based on when benefit begins. Benefit begins after an accumulation. I hope everybody should know that benefit begins after accumulation. Now, what it means that based on when benefit begins means that when amortization begins. So some people will say, all right, this refers to what timing of income payouts. That is when the income be paid out. You can do immediate annuity, which means you want to receive the benefit immediately. You can do deferred annuity, which means you want to get the benefit over time. Now, can you link number one to number two? This is we are saying that if you get all this thing we're saying, you have no annuity. If you don't get it now, then it's become difficult. This classification is where we have the confusion. And if that's the only thing we're going to do tonight, that'll be fine. So the first classification is what's based on premium, how the premium are paid. That's when you are paying money, the accumulation phase. And the second one is that the benefits, when benefit begins, that's when amortization begins. Remember, in annuity, you have the accumulation phase and the amortization phase. The amortization phase is the payout phase. That's when you begin to receive your benefit. Now, the first classification is based on what? How you pay the premium. That is how you put money on the annuity. You can put it as a single premium, and again, you can put it as a flexible premium. Single premium means lump sum. Flexible premium means multiple payment over time, which means if you write a annuity policy for 10 years, that one for 10 years, you can decide to pay the accumulation period within 10 years period. Now, somebody again wrote for 10 years, now want to pay the annuity lump sum, one time. You definitely, without somebody telling you, you have known that the person that paid lump sum one time, we have much accumulation of interest, more than that person that paid multiple payments. It is clear. Now, the second definition or the second classification is based on when your benefit starts. When do you want to start amortization? When do you want to start getting the income? When do you want the income payout to start? That's what's another second classification of annuity, based on when benefit begins, based on when amortization begins, based on when income payout begins. So the first one is what? Immediate annuity. If you do immediate annuity, where do you think, which of the income? Oh, sorry, please. Just give me a second. Sorry, please. Yeah, Chama. Yeah, how are you? Yes, how are you? Are you at home or school? Where are you? You are still at school? You're gonna use Zoba because I'm not around. You know that? All right. All right. Call Favor. Call Favor. Just call. All right, sorry, please. So we have known the first classification. We're going to the second classification, which is based on what? When they pay
Income
out.
payout.
Income payout, which is what we call amortization. Please pay attention to the classification, please. This is where it confuses people. So on this classification based on income or benefit, when benefit begin, or when income payout starts, or when amortization starts. Now, it can be what? Immediate annuity, or it can be deferred annuity. So can you link number 2 to number 1? In the number 1, based on how premium are paid, single premium, what kind of benefit do you think we can relate it to number 2?
Hold on. Immediate.
What kind of premium payment accumulation period that can relate to number 2 amortization period? What kind?
I'm not understanding it.
I want you to understand. Where is the confusion? Tell me now. Remember,
Hello, sir. What did you say about amortization period?
what I said about amortization period, which is what? The income payout period. I said, I want you to relate it to number 1, which is the premium based on accumulation of premium, paying of premium, the annuity. I want to relate number 2 to number 1. What type of payment funding that will relate to income payouts?
That is lump sum.
Single premium.
Annuities. You compare the single premium to immediate
with
annuity.
the immediate annuity.
All right, that's what I want to hear. Yeah, oh, sorry, I entered class. I'll do that now. Sorry. Yeah. All right. So you can see that single premium with immediate annuity and flexible premium with deferred annuity. You can see 2 of them match. Yeah. Please, who does not understand it here? Because you're going to see this in exam. Who does not understand these 2 comparisons now?
I did not, because I didn't join people from the beginning.
All
Can
right.
you please go over it one more time, please, sir?
All right. So what I'm saying, in annuity, we have a period of accumulation and we have the period of amortization. The period of accumulation is the period you are paying in money to the account, which is what we call the funding. Now, the another one is benefit period, which is the amortization period, which is when benefit or income payout will start. So whenever you hear amortization, it means what? The payout period or the income payout period. Now, when you hear of accumulation means that period you are paying money into your annuity or the funding period. So now we are classifying annuity based on 5 categories, several categories. Severally, there are up to 6 or 7, but we're going to do only with 5. What I'm saying that if you can understand these 5 classification, you are done with the annuity. Then everything we're going to say on annuity will be easy for you because you do now understand what it means. So if you classify annuity based on, these people are giving me headache today. If you classify annuity based on when you are paying in the money, that is the funding stage. We have what's single premium, which means you can pay in the annuity, which is the accumulation. You can just pay it once. We call it single premium or one-time lump sum payment. Another way you can fund the annuity is through what we call flexible premium, which means you can fund the annuity over time. You can decide that every 6 months, every month you pay so amount, every 6 months you pay so amount. You can be paying like that until you finish up the accumulation period based on the years of your annuity. Sometimes some people can choose 5 years annuity, some can choose 10 years, 15 years, 20 years, some can use 30. But remember, the longer the period, the more money you accumulate. So that's why it's very good for somebody to do it right now that you are still young. Do it so that by the time retirement reach, you have accumulated much money. So one of the ways is what? Through single premium, you can pay one time, or flexible premium, you can pay multiple times. Now, let's talk about the benefit period. The benefit period is the income payout period. Now, the income payout period can be one through immediate annuity or deferred annuity. What is the immediate annuity now? We synchronize with what? Single premium. Because if you pay a lump sum payment, your income payout will start immediately. But if you pay a single premium, a flexible premium, which is multiple payment, what it means that the income payout will be longer, deferred. It will start in future. So if you understand classification 1 and classification 2, means that you have understood what we are saying since today. So any confusion?
I think we're clear.
Anybody who did not understand? Who did not understand? Say it now.
Nobody.
All right. So that is what classification number 1. Classification number 1. Now, and number 2. Now, let's go to classification number 3. You can classify annuity based on source of income. Source of income is that from where the money comes, from where the funding comes. That is source of income. Where do you get money to fund annuity? It said there is 3 ways you can get money to fund the annuity. One is fixed annuity. If you fund your annuity from a fixed annuity, you are guaranteed a payout period. If you fund your way from variable annuity, income will be what? Payout vary based on investment performance. If you fund through index annuity, is linked to a market index. Based on source of income means that how do you, after funding your annuity, what area will you be getting the money that will be entering, the accumulation that will result to interest that you'll be getting? How does it come in? Now, let's assume you do a fixed annuity. If you do a fixed annuity, it means that you are guaranteed the payout, which means income will be moving in. Now, if you do a variable annuity, payment may vary based on investment performance. Now, if you do through index annuity, you have linked it to the market index, which means the market performance. If the market is good, your annuity is good. If the market is bad, the annuity will not get anything. However, because it's indexed, you cannot participate in the loss, you participate in the gain. Is that clear to everybody? That is the 3rd classification. Any confusion?
Engineer Abati, honestly, it's confusing.
But I said it.
I must tell you the truth. It's very, very confusing.
I said it. This is where it get messy. This is where it get messy. But if you grab it, it's okay. So let's go back to number 1. But everybody who did not understand the classification based on how the premium are paid, who did not understand that? Anybody? That's how you pay your money to the account. Who did not understand that? We are how many of us here? 14 of us here. Anybody who did not understand this should let me know.
So, sir, basically the single one is, let's say I put 50,000 in my annuity right now, that means I can take out 50,000 right away. That's what that single annuity means. Just want to be sure.
All right. Yes. But it's not taking out 20,000 at a go. Remember, this is a contract. There's always terms to a contract. During the contract, you have decided that, look, if I put this annuity for 5 years, the accumulation will be 5 years. But you decide that you're going to pay a single premium. You pay that single premium. Yes, you are qualified to start a payout because payout to start after accumulation. But what you're going to ask yourself, has that 5 years that I signed the contract reached for me to start getting money? However, if that 5 years has not reached, since you have paid a lump sum, you'll be getting interest immediately.
Okay,
Is
let me
that
let me
is
interject. Let me interject. Yeah. So what Engineer Ba said is true, but single premium means that, for example, I just wrote a policy for somebody is 120,000. That is the premium. 120,000 is the premium. But now, how long will the contract last? If you have signed contract of 5 years, it's 5 years. If you have signed contract of 10 years, it's 10 years. Mr. Fei, it does not mean that you have to go take that 120 out. If you do, remember this is a contract. For example, if you have signed contract of 10 years, you cannot take that money out for 10 years. If you do, you're going to incur surrender charges.
penalty?
Okay, you're going to incur surrender charges. Okay.
That's
However, why annuity, which is Internal Revenue Code
Yes.
575, why annuity is a very good is a good strategy to work with is that every year some of them will allow you to take out up to 10%, 5% without penalties. However, depending on where that money is coming from, let's say this single premium is coming from your 401k, for example. The rules of the 401k also applies here. So if you decide to take 10% next year, or maybe you brought 120, you decide to take out 10%, that's the highest you can take without penalty. But you're not 59 and a half yet. You still have to pay what? You still have to pay your state and federal income tax and the penalties for the government. But there's no penalty from the annuity. Did you get that?
Okay.
Okay. So single premium, which is majority of the policies I've written are all single premiums. Majority of them. You have 200,000. I move them. I have a physician that have 500,000 in their 401k. We roll it over where she worked before. We roll it over in fixed index annuity. That's a single premium annuity. Now, multiple payments means annuity you started, but you have the right to add money all the time. Every month, you have the right to add money in it. That just is not based on distribution, taking money out. It's based on how that annuity started. Okay? Does that help?
Yeah.
Yes.
So where does compounded interest or something like that come in?
Compounding is based on what you have. Let's say if I submit a rollover 120, and this year you make interest of $5,000, right? Next year your interest is no more based on 120. It's gonna be based on that 120 plus the 5,000 you made this year. Okay, but if the market goes down negative, right, you will never lose that $1 from that 5,000 because you can never lose in annuities. Never.
In a fixed annuity.
In fixed index annuities, you can never lose.
Okay.
You might if you're paying what do you call it? If there are fees, depending if you have riders, okay, you might see some loss due to the riders, not because of the market fluctuation. Okay. So just know enough to pass your exam. When you come out, these are the things you're going to learn every single day. Okay, you're going to learn this every single day. All right. So, but they are what they are doing here is classifying annuity in different categories. How the premium are paid, based on when benefit begins, which is say that's what you're trying to mention. But when the premium begins, it's not really tied to how premium are paid. Okay. And based on the source of the income. Okay. So if you're able to know it this way, you're definitely going to pass it in the exam. But majority of the people, what they have is single premium. Annuity, majority of them.
All right,
For
thank
those,
you.
for the client I've dealt with, not that I don't say, not majority of the public, for the people I've dealt with, majority of them are based on the income where the money is coming from.
Okay.
All right.
I'm happy you guys are learning. These are the things we ask you. Come and learn. Oh, this is the ABCD of America. And yet, people don't want to learn. Somebody sit down and tell you that this is your reading now is a scam because they watch a 2 minute video on WhatsApp, on social media, and they throw it to you as a scam. The truth is that the law of the land must stand, whether you believe it or not. The law will stand. And anybody who doesn't know the law and does not have their stuff and be in charge of their money will suffer the consequences of not knowing the law. So what we're trying to do is to how to get to middle class. Come and learn what is not taught in the classroom. So at least you can manage your own money. When I retired, it took me 2 days to move my money and I lost $6,000.
That's right. Yes, true. Question.
All right, go ahead, sir.
Dr. Ruth,
Yes, ma'am.
can you have multiple accounts in annuity? Maybe one a fixed one, maybe
You
like
can have hundreds
Yes.
as long as you approve.
Okay.
You can have hundreds. The question, will you be approved, is not automatic.
Okay.
They have to approve you suitability. That's what they call suitability.
Mhm.
They don't look at your health to give you annuities, but they look at your money.
Okay.
Okay. So you can have as anywhere you have worked before. And you have some companies that allow $5,000, some allow 10,000, some allow 25,000. That's the minimum. Okay. So depending on that amount, you can roll it over to a fixed index annuity. Most of the time that will fall under single premium. Okay. As long as you have worked somewhere, you have the right to roll over that money from one place to another place without paying taxes and without penalties.
Okay.
That's the law.
All right. So, Dr. Wu, thank you. Who is on iPhone? I'm gonna take you off if you don't put your name. The information we are distributing here is information you cannot get in your classroom, which means all of us
Don't
have to
even worry, I
identify
took them out.
ourselves.
Don't worry.
So, if you
Doctor, it's me, Marie.
oh, Marie, how are you?
Not bad. It's me, and
Where did you go before?
I got really sick.
Oh, sorry.
sorry.
Sorry, my dear.
Yes.
Sorry. You're
Yes.
welcome. Sorry. So go ahead with your question.
No, I don't have a question. I just
All
want to
right.
know it's me, so don't
All right,
block
all
me.
right. All right, all
Thank
right.
you.
You're welcome.
I Dr. Fedora. Dr.
Yes.
Ruth.
Yes, ma'am.
Good evening.
Good evening, ma'am. How are you? I'm happy you're back. I hope
Yes,
you're feeling
thank
better.
you. Yes,
right.
ma'am, I am. Thank you.
All right. Sorry. I was like asking where did Maria put it?
So
Yeah,
hold
very
on,
sick.
honey. You see, I've taken this iPhone out like 3 times and they still come back. All I needed to do, unmute, tell me your name.
Dr. Ruth, what did I do now? You've been cutting my line.
Who is that?
Reaching on him.
I've been asking to say your name so I can rename you, but you don't say. I take you out. Your name is not on your iPhone. Okay.
Yeah.
So
All right.
please, we want everybody to identify himself because honestly, the information we are getting here, particularly in this section of the teaching, is more than every other thing. So we should be able to know who we are, identify the person that is in here. It's not everybody that's
I will
supposed
find
to
a
talk.
way around it, and I don't know why it's not showing on my
All right.
iPhone, because when
So,
I'm using
Dr. Ruth,
laptop, it will show.
Dr. Ruth, thank you, you're welcome. So the classification is what we are still in there. You get to know what it is. Honestly, if you miss the classification, you have missed annuity. That is just the basic truth. Because the question we have here is what we are doing here now is one of the things you must see in questions. This classification is what can cause confusion in the annuity, and that's what will make you not to do well in annuity. So please pay attention to it and ask questions if you do not understand. So let's go to annuity classification based on source of income. So where did the money come from? When you benefit, the benefit, what income, where the source of income? Can it come through guarantee payouts? Can it come through payment vary based on investment performance? Like, can it come through investment performance? Or can it be linked to the market index? Now, the fourth classification is what? Based on disposition of proceeds. That is distribution. After the accumulation phase, you begin the amortization phase. So when you reach the amortization phase, how do you want to be distributed? How do you want the amortization phase to be, the payout to be distributed? Do you want it a lifetime, which is income for life? Do you want a lifetime annuity, which means payment continue for the person's entire life until the person passes? Do you want a period certain? That's what it means, that you want the payment or the distribution to be for a fixed period? Or do you want a refund option, which means remaining value paid to your beneficiary? Let's assume you are receiving the benefit and the person passes. It's left to you to say, if I pass, let the remaining one go to my beneficiary. For instance, you are receiving $2,000 every month, and you couldn't finish it up, you die. Then what happened? The remaining one to go to your beneficiary. That is a refund option. So you can see that this classification is how you can structure your annuity and how do you want it. So the more you get knowledge of this, the more you can be able to put an input. Make an input when your own annuity is being written. Or the more you can even teach other person, because the essence of coming here is one day you teach your client, you teach your customer. Now, you can now classify annuity based on what the number of lives covered. How many annuitants? Remember, we said the annuitant is that person who do what? Who collect the benefit. Then, how many number are in the annuitant? Is it single life? Is it one annuitant? This is one person that can be collecting the benefit. Or is it joint life? Is it two or more annuitants? Is it two or more people that be collecting the money? Of course, joint life of most times is between spouse. The spouse and the husband and the wife can decide they're the annuitant. They can be the contract owner. They can equally be the annuitant. Or the husband can be the contract owner. The husband and the wife is the annuitant, which means two of them can collect money out of the annuity. Or it can be the wife, then the husband and the wife can be the annuitant. Or it can be one of them, they bring their children to be the annuitant. So annuitant can be two or more. When it's joint life, the annuitant can be two or more. When it's single life, the annuitant is only one person. So if you know all this classification, your designing of your annuity become easy for you. You can now design it based on what you want. For instance, let's look at the payment, the premium payment period, which is the accumulation. I can decide to do a single premium. Another person can decide to do a flexible premium in accumulation phase. Then on the benefit, I can decide that, look, my income payout period should be immediately. In that way, I can go for single premium. Then another person can decide that, look, his income payout can be a deferred annuity. In that way, most importantly, you can go for flexible. Then, based on source of income, I can say my annuity, I want it to be fixed annuity. Another person can say, no, I want it to be variable. Another person can say he wants index annuity. So it depends on what you want, on the design, on the performance of annuity, depends on what you want, on the design, and again, on the performance. The way you design it will determine how it performs. It's almost the same thing with life insurance too. In as much as we say life insurance is opposite of annuity, or annuity is opposite of life insurance. If you write a policy in life insurance, you write that policy, you decide to add more
Rider.
on it. Don't you think that life insurance perform more than somebody who doesn't put any rider? Yes. I normally use pizza. It's a very good illustration. Me and Sei went to Pizza Hut. I think Sei is here. Me and Sei, I think Sei is here.
Yes, I'm right here.
Yeah, all right. Me and Sei decide that we want to go to buy pizza. And we decide that when we are in the same car, we are going to pizza center to buy pizza. And we decide that, oh, say, oh boy, I might need veggie pizza. I said, all right, we buy basic pizza. When we get in there, say just decide what you buy. When I get in there, I asked them how much is veggie pizza. They tell me $20. I gave them $20.
Thank you.
For my own. Say no. Ask Say, what do you want? Say no. I want veggie pizza too, but I want in that veggie pizza, I want mushroom, I want pineapple, I want carrots, I want more vegetable, I want meat for protein. Say you put all those things. Meanwhile, it's the same pizza.
Both of them are not veggie pizza.
No, that's the correct way to describe it. So now I have decided that I'm carrying my pizza $20. I paid them $20. But say he decided to put all those are what we call riders.
They're the riders.
They are riders. Remember, I paid $20. Are you telling me that Say will pay $20?
Say he's gonna pay $35, maybe.
In the premium of the pizza, I paid $20. But Say not gonna pay $20. Say we pay up to $40 for the premium. Is the premium the same? I mean, is the pizza the same? Of course, it's pizza, but do they have the same quality? No.
No, they don't have the same quality.
So that is exactly what life insurance and annuity is.
Additions are it's like addition, adding more.
Yeah, you decide on what you want to do based on what your intention. If you're writing life insurance policy, it depends on what your intention is. Those riders are there. You want to add them. Yes. Remember, they're going to attract more money. Of course, you see that we bought the same pizza, but Say you pay more than me. Those riders has a premium attached to it. Small money attached to it. So if you now add, as more rider you add, so as your premium will increase. That's exactly how it is in what? Annuity and life insurance. So some other person will just go and just buy life insurance and go, or buy annuity, start annuity and go. It may not be the same thing with every other person. So the more you add, the more you pay. And however, even in life insurance, the more you fund your policy, the more your policy perform good. That's what some people don't know. You buy a life insurance policy, you are paying monthly. Somebody bought life insurance policy, that person is paying annually. You don't expect two of them to be the same, not even annually. You can put money as you like in your policy. However, you cannot put more than required in a year. So you continue to put that money. The other person is paying every month. You pay the minimum amount that will keep the policy alive. Then this other person said, no, of course, I want more accumulation. I decided to add more money to it. You can't say two of them are performing the same way. No. They said there was a difference. So that's how it is in life insurance and annuity. All right. So let's go classification based on premium. Do you remember we have said all this now, but let's go in detail.
We said it's 5, but I think we did.
No, we did 5. We did 1 based on how the premium are paid, which means how you fund the annuity. Number 2 is based on when benefit begins, when amortization starts, which is the income payout, when it starts. Number 3 is based on source of income, which means income to be derived from the annuity. How do you want it? Do you want it fixed? Do you want the variable? Do you want it index? Now, based on disposition of proceeds, how do you want the payout to be distributed?
Okay. Yeah, based on the number of that I didn't have.
All right, based on disposition of proceeds.
No.
Is the number 4?
No, based on the number of lives covered.
Oh, based on number of lives covered. Which one is that? Based on source of
51.
Number five.
Oh, number 5, based on number of lives covered. All right. Based on number of life covers is what coverage can include what single life, which means one person is designated to be the annuitant. It can be the contract owner. It can be another person the contract owner so much love that he said this person should be the annuitant. If the contract owner decide that Mr. A is going to be the annuitant, the contract owner cannot collect the benefit thereof because he has assigned somebody to be the annuitant. Now, if it is a joint life, so which means the number of lives covered can be joint life. If it's joint life, it can be 2 people or more. Let's assume husband and wife is what the lives covered in that contract. The husband can cover and say the wife become the annuitant, or the wife can cover and say the husband become the annuitant, or the husband can cover and say the husband and the wife become the annuitant, or the wife can say the wife and the husband become the annuitant. However, you can decide that, look, in the joint life, I want all my children to become the annuitant. You can say so many people can become the annuitant. So that is single life is when one person is annuitant. Joint life is when more than one person, 2 or more persons are the annuitant. Is that clear?
Yeah.
All right. So classification based on what? Premium payments. Of course, I've said premium payment, which we said number 1, it can be a single premium. Number 2, it can be multiple time payments. So that I don't think for us to still go back to it, there is nothing we can get there. So single premium annuity are characterized by lump sum single premium payment. In other words, the annuity is fully funded with a single premium payment. That's it. Go ahead. Somebody want to say something?
No.
All right. So monthly income payment to the annuitant may begin immediately. Of course, when you do a lump sum payment, the multiple income payout can start immediately. But however, just like I think Shay asked that question, you cannot say because I've done a single premium, you just decide one day, go there, say you want $10,000 from the account. No, it doesn't work that way. Remember, the contract you write is 40 days. I mean, 10 years. So, and now you decide to, because do a single premium, which means the accumulation phase have ended, the annuitant phase can start. Then if the amortization phase starts immediately within 30 days, in that contract, you have specified how do you want to receive the money. Remember, go back to this, the payout period. Remember, premium, how single premium, how premium are paid. The second one is that based on when benefit begins. How do you want the benefit? Remember, in the contract, you must have indicated how you want it. And not only indicating it, the contract will now tell you how much you'll be receiving in a month. If you want it monthly, the contract must have specified by their calculation how much you'll be collecting monthly and when the amortization will end. Then that's why, based on that, when the amortization will end on the terms of the contract, you can be able to say, If I'm no longer within the ward, let my beneficiary collect the remaining. All those things are specified in the contract. Is that okay?
Yeah.
Now, let's go to, we have finished the single premium, of course. So single premium, the amortization can start immediately within 30 days after the single premium are paid. Single premium annuity are either single premium immediate income or deferred income single premium. So do you understand that? If you pay a single premium, which is lump sum payment, you can decide that the amortization you want will be, is you do the single premium income and you want the money to begin immediately. Or you can decide, says, you have paid a single premium, but I want payout period to be deferred from so period. You understand? I think, to me, the one that can give you and yield more interest to you is deferred income. Even if you have done your single premium today, you paid, let's assume you pay 100,000 in your account today, you have finished accumulation. Now you decide you don't want to do the immediate annuity, amortization. Now you leave your money there to be there for some period, which is deferred income. Don't you think that within that period, you must have your income will yield more for you?
Yes. So for sure.
Yes. So based on it, is there any need for you to, you do a single premium, you just want to begin to want to withdraw money out of it? It doesn't help. However, just have in mind that, like every other person will think, annuity is for retirement. So there's no basis of you to go and touch what will help you in retirement and go and cut it off when you are still strong working, no matter how the pressure comes from. You keep it there, no matter how the pressure. You know, sometimes there's some income you don't touch, just keep it there, no matter how the pressure come around. Yep. Because those ones you know that can deliver you in whenever the pressure is too much. Do you have to touch them? No. So you can do deferred. So when annuity is funded in a single premium, a single lump sum payment, the principal is created immediately. Generally, this type of annuity does not permit the contract holder to make any additional deposits into the contract. You see it? When you pay a single premium, the contract does not allow you again to do and not to continue the accumulation. You cannot pay any other money in that contract because you have already paid out, you have finished the accumulation phase. At that point, you will say the contract has been fully funded. No other payment allowed. Otherwise, if you have money again, you can open up another annuity. Yeah. For instance, if your annuity is let's assume 100,000 single premium, you pay the 100,000. You are not going to pay any other money in that account because the account has been fully funded. All right, let's look at this scenario down where I highlighted. Let's look at it. I highlighted it now. Let's look at it. He said, for example, Jordan, age 50, won the lottery and received 500 million payouts. Remember, those who won lottery doesn't behave good. Jordan, what I mean they don't behave good is that sometimes they carry the weight because of the money and they get at a point, get lost all their money through a wrong investment. Jordan, age 50, won a lottery and received 5 million payout. After consulting with his financial advisor, Jordan decided to use 1 million to build a house and pay off existing debts. He used 1 million. How much did he receive? 5 million. He used 1 million to build a house and pay off existing debt. Is that a wise investment?
Well, he still got 4 million left.
Yeah.
Yeah, it's a wise investment. At least he pays his debt off. Then why investing the remaining 4 million in a single premium annuity? Jordan now needs to decide whether to begin receiving income payment from the annuity immediately or defer them until later dates. So he now invests a 4 million that remaining into a single premium annuity, which is lump sum.
Fast move.
So if he decides, he has the right to say he wants to receive the income immediately. And he also has the right that he wants to defer receiving the income to later dates. If he decides to start receiving income, will you expect the interest accumulation to be the same than when he decides he wants to collect it in later time? No.
It cannot be the same now.
It cannot be the same.
When he defers it, the interest will be higher.
Of course. So that is exactly how it applies to every other person who might think that if he pay, he start receiving income. Yes, you can receive income. Of course, lump sum within 30 days, immediately you can start receiving income. But does it help out? And what is the contract? What does the contract says? Did the contract say 5 years, or the contract say 10 years? If the contract says 10 years, they are expecting you to stay 10 years before you receive. Otherwise, you're gonna pay some fine, some penalty for coming earlier to get the money. Because as the money is, the interest is building up, they're equally using the money to build out their own. All right, so level premium annuity. A level premium annuity is characterized by a constant payment to fund the annuity. Whenever you hear level premium, it means that the premium is fixed. It means the premium remains the same. The premium does not change. Level is the same. You can see a level premium in insurance policies. It means that what you are paying today is what you are paying tomorrow, or what you are paying till the policy ends. So in a level premium annuity, it is what's known by the payment to fund the annuity. This type of annuity is also called the annual premium annuity. So we have entered where it gets confused.
Yes.
Level premium annuity. Know that whenever you see level premium, it means that the premium paid to the fund of annuity is constant. It does not change. You can allow the premium to be paid monthly, quarterly, or semi-annually. However, the same amount, the same payment all across the board. If you decide you are going to pay the premium monthly, means that they're going to pay what you pay in June is what you pay in July and what you pay in August. If you decide that you are going to pay quarterly, which means every 3 months, every 4 months, means that what you pay after first quarter is what you're going to pay in second quarter and third quarter and fourth quarter. If you decide it's a semi-annually, every 6 months, means that every 6 months you're going to pay the same. You're not going to pay one particular amount this month. After the next 6 months, you pay another amount. No, you're going to pay the same amount. It's like that in life insurance. Sometimes if you're paying in term life insurance, we have level term. Level term means that the premium you are paying in that policy is the same throughout the life of that policy until that policy terms. If you have a fixed index life insurance policy, the money is level. The premium type is level. If it's level, then what it means that what you're going to pay today is what you're going to pay tomorrow. So all this depends on your ability, what you can afford, and how you can arrange it to work for you. Any question at this point? All right, I think we're going to jump here. This is a scenario, we're gonna jump it on. We have a flexible premium deferred annuity. Flexible premium. It means that the premium differs. You can pay monthly, you can pay quarterly, you can pay semi-annually, you can pay annually. If it's a flexible premium annuity, it's characterized by periodic premium that may vary in amount. The contract owner determines what? The amount they can afford to contribute each year. You see, the one thing with annuity is that nobody will call you to say you have not paid today. Because remember, you bear the risk. The contract owner bears the risk. That's the annuities. The contract owner bears the risk. But in life insurance, the contract owner does not bear the risk. The life insurance bears. So that's why they can call you to make sure you pay your money. But in annuity, you, the owner of the contract, you bear the risk. So whether you decide you're going to pay is your business. Whether you decide you will not pay is your business. Nobody will, nobody will kill you. So whatever you decide to happen is what will happen. Is that clear? All right. So I want us to, this, annuity is a very big, wide, it's very wide. So classification according to when benefits begin. Whenever you hear when benefits begin, it means that accumulation phase has ended. Now you are in amortization phase. That is what a distribution has begun. Payout has begun. Amortization has begun. So that is amortization phase. So annuity may be what described according to when the payout or distribution phase begins. When the amortization period begins, that is when the income distribution begins. That is when you now begin to receive the money. Excuse me. So I get to eat. All right. So sorry, everybody. Here. So the immediate annuity. We're going to talk about immediate annuity. Remember, in immediate annuity, the lump is a lump sum payment. But in that lump sum payment, you can decide that you want to defy it. If the more you defy, the better for you, the better income stream you get. I think the design of annuity, based on our understanding, what we have learned initially, is actually meant for your retirement. So the money you're going to put there, put your mind, say, this money is what? For my retirement. Yeah, if you remove part of the money, you keep it in the bank like that lady I told you guys about, make sure that, let it be in your mind that, look, this money is for my retirement. When I can no longer work, when my children must have gone to their husband, their wife place, when I am alone, so it's a retirement period. So that money, annuity should be is most important design for your retirement. Make it an income stream for life. So there's no need even thinking about going to touch it, no matter the pressure. If you have it, keep it there. If you don't have it, go and get one. Even if, no matter how small, get one as you can afford. It is very, very important. Just so as life insurance policy. Life insurance policy. I know everybody, almost everybody here should have a policy. At this point, you have, with the little knowledge you have now, you should not be reminded to go and write your policy. Life with the little knowledge you have here, try. Let's try. If they don't approve you, know that they didn't approve you. But try. The little knowledge you have here have differentiated you from every other person out there, from your neighborhood who have not entered this class, from your friends who have no idea of what you are going through now. The little knowledge you have here have differentiated you from them. So if you don't have a policy, go and write one. Tell the person who brought you the business to help you. Put in one. The earlier, the better. Tomorrow may not be known. Please. It's very, very, honestly, it's very, very necessary. No matter how small, do as you can afford. If you have your grandchild, their grandchildren just have a baby, or your children have a baby, have a small baby. Now that you are now becoming an educator, That's what financial educator, whether you like it or not, that's what you're about to become now. Now you're about to become a financial educator. Don't you think it'd be good for that baby born today, for that baby, for them not to do bad day and use that bad day money to put a very good life insurance policy for that baby? That baby is not going to ask you whether you do bad day or not. That baby will be happy that grandma, grandpa, this is the gift from grandpa, grandma. The baby will be so happy. When he knows, when he or she come out to know the help you have rendered, he'll be so happy. Don't you know that? He'll be so happy. Then, oh, you do birthday for him, you bring everybody in Texas to come to your house or come to a hall to eat food 1 minute and go. The baby will not be annoyed. I mean, be very, very annoyed. Then you use that money. Some people will celebrate birthday, but their children don't have policy. Honestly, if you allow that to happen now that you have known this, then it becomes a big problem. Educate those, educate other people around you. I'm telling you the truth. You cannot get this education we are getting now anywhere else. In all those who have PhD, I know some people have PhD here, there's some doctors here. Since you have been reading book, Dr. Ruth will tell you that since he was alive, he has been reading book.
Yes, so.
Those of you that are doctors, have you one day seen this kind of education? It will not be nobody will teach you that. You are making money, apart from wasting the money, not doing the thing that will help you. I was opportune to be in somebody's hospital bed. And what I saw that day, I shed tears, honestly. And what I'm telling you is a true story. I was opportune. I was in that room with the man, the wife, and the two children coming to the room. The man started crying. Somebody who is sick to the point of death started crying. Somebody, oh my God, somebody who is sick to the point of death. You know, imagine somebody who is sick, who knows that he's not going to make it. Somebody who knows that he could not make it. Who is in a trek, but started crying. Because of what? He was the only breadwinner. His house will be foreclosed.
Oh.
He is thinking, upon he cannot say it out, he is thinking how the two children and the wife, how are they going to live? I'm telling you that this was what I'm telling you, the true story. Initially, I thought the cry was because of maybe the children entered. Maybe they are doing him wrong. You understand? That was my thought. Maybe he doesn't want to see them. That was my initial thought. Now, I took the first son out to speak. I didn't want to take the wife. I took the first son out to talk with the first son. I said, what is going on? The guy told me that is going through a lot, not even about the sale. I said, what is that? He said, because their house is getting foreclosed. And now, when I speak a little bit with the first son, I now enter the side. I look at the wife, the lady, as the husband is crying, the lady is crying. So I took the woman out. Honestly, if I have 450,000 that day, believe me, I would have write a check for them to go and pay off that house. I'm telling you the gospel truth because I was touched. I took the wife outside. I asked the wife, what is the problem? He said, yes. He said, their house, this month is the last time they gave them, they're going to chase them out of the house, that all their bills have not been paid, that the house is getting foreclosed, that they have not lived in that house for more than 10 years before this problem comes up.
Right.
So I just stay. I didn't know what to say. I come out of that room. I said, God, why? I was touched. I just left because I know if I stay more than there, I may start shedding tears. Honestly, I left the room. I just went somewhere and sit down. Because this man is in a trek. Upon that, he cannot speak. He is crying. And this is the man who have contributed enough to make sure his family are okay. Then you and me that are staying alive, what do you think we can do? You can be approved in life insurance and you are still there. You are waiting until you feel it's a scam. You can be approved. You are making even $1,000 every month. You can be approved. Go and write your policy, no matter how small it is. And the best thing that can happen to you is that you write that policy, let it cover the cost of your home. So that when you are chronically or critically
Can you
ill,
add that in a rider?
of course.
Oh, really?
Of course. When you are critically or chronically ill, they will give you part of the benefit. You carry the benefit to go and settle those things that make you cry when you are in the sick bed. Yes.
That's so sad.
No,
the person is going to hell, but he didn't even die yet.
What I'm telling you before God and man is what I witnessed. If I have money that day, I will write a check for them. There's no way I will leave that room without writing a check for them. In that case, even if you go and give them 5,000, it's not going to do anything.
No, it's nothing.
Because the foreclosure is already there. So the only thing that will solve the problem is to pay off the home. Had it been this man had a life insurance policy, let's assume that this man has at least 500,000 life insurance policy, and they are owing 450,000. They will at least, and he is terminally ill, they're going to pay him at least 90% of the death benefit. What's going to happen? He used that money first to pay off the home, so that at least his family will see where they are. Even the man will be normal. So that the man is dying, he'll die in happiness. So I don't know. See, sometimes our community is unbelieving, particularly those who are from particularly those who are from Nigeria. They have this kind of mindset. Sometimes I don't know. I told you guys the first policy I wrote, 2007. We are 14 in an office room.
Yeah, you said that.
Believe you me, upon that 14 people in that room, nobody write policy except me. I'm telling you the truth. And I do not know what it means. What is policy? I come to America in 2007 and I wrote that. I do not know what it means. But the only thing that comes to my mind then was, I beg, let me write this. I say, if I die, my family collects. Tell me, if you are keeping 80,000 for your family, is that money? So all this is mindset. We should be able to make amends, please. 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 Yeah, there's celebrating all those celebration, whereby no, there's nothing there. It doesn't make sense. All right. So let's look at immediate annuity. An immediate annuity was designed to generate an income stream to the annuitant soon after it's purchased. You write immediate annuity, you can generate your income immediately you purchase it. Within 30 days, of course, you can start generating your income. But if you can defer it, it's better. The interest will be better to you than when you start collecting immediately. However, by the contract, you can start collecting immediately if you like. The first installment payment to the annuitant can begin as soon as 30 days if the annuity is funded or purchased. The first income payment from single premium and immediately annuity must be made within 12 months of the contract date, of course, which means if you do lump sum immediate annuity, your first income, no matter what, within 12 months, you must receive the first income. You must receive first disbursement, first benefits. So an immediate annuity can only be funded with a single lump sum premium, of course. This means that there is no accumulation period since only a single premium payment is made. So in a deferred payment, that is we can have accumulation period. In a single premium, there is no accumulation period because only one payment, lump sum payment was made. And when one payment, lump sum payment is made, you can start within 30 days to start receiving your income. The income payment made to the annuitant consists of both principal and interest. So what you are receiving, you are not only receiving, let's assume if you do 100,000, you are not only receiving the 100,000, you are receiving 100,000 plus interest on that 100,000. So let's assume you do a deferred annuity. Don't you think that the principal plus the interest will be more? Because you defer collection. So as you defer it, the interest yielded will be more than when you start immediately. I think that's correct.
Yes.
Yeah.
All right. So as with any annuity, the period during which annuity generates income for the annuitant depends on what? This what can determine when you generate the period of income can be generated. One, the total amount contributed to the account. How much is the annuity? How much amount did you deposited initially? How much was the paying period? How much? Since in a single premium, there is no accumulation period, because the payment has been made, the annuity has been fully funded. Then the money you're going to get, how much is it? The bigger the invested, the more money income stream you will get. Another one is the settlement or distribution option, which means I already said it, the settlement or distribution option. If you decide the settlement to begin immediately, you're not going to get more. But if you start the settlement to be distributed, then you're going to get more. It's still going to be compounding there for you. Remember the definition Dr. Ruth gave before? That look, the compounding effect is this. You have 10,000 in your account. The interest you are getting for that 10,000 is $200 every month. The next month, how much is going to be compound for you? $10,200. That month, you get another $200, which is $400. The following month, the interest that will be compounded to you will be $10,400. This is exactly how our loan payments are being met. This is exactly how our mortgage are being paid. This is exactly how our auto payments are being made. That is why you start payment in auto, you have a car loan, it doesn't finish. You have mortgage payment, it does not finish because it's compounding. They are just compounding effect to punish us. You start your mortgage, they tell you 15 years. Believe me, it may not end in 15 years.
To punish us.
No, but that's the truth. Because you know the reason why it doesn't end that way. You have a $400,000 to be paid. Now, you paid $100,000. They take $98,000 to pay off their interest. The interest generated automatically from that $400,000. Now, how much remain? What remain is what? 300,000. I mean, what remain is 300,000, $398,000 because 2,000 is only what go to your 2,000 is only what go to your principal. Yes. Now, that principal that remain there actually is yielding an interest, and that interest is being added to the one you think you have paid. So there's this compounding effect. That's why we cannot be able to finish our loan, any loan payment. In fact, the people that specialize much on doing it is the credit card industry. They use compounding effect. They ask you how many percentage, and that's exactly what it is. And they will tell you you can pay minimum of so amount in a month. That is where the danger is.
Yeah, you keep paying.
So anyway, so let's go ahead. So the longer the period of desired income payment to the annuitant and the more guaranteed provided, e.g. period certain, the lower the amount at each installment. The income from the annuity may either be fixed dollar amount. The income can be fixed dollar amount. That is, you want it so amount every month or every year, or it can be variable sum, which means you don't want it to fix. This month you can collect 1,000, the next month you collect 2,000, you know? It can be, you see, one thing with all this thing we are saying that all this thing will be in the contract. It's not that you come up to start to initiate one. All of them is in the contract at the first day you are putting in the contract. So there is no negotiation after the contract become binding. So whatever you are doing, you do it, you design it as you are doing what? Preparing the annuity application. So that's the more reason why, if you know, you can now follow to design your annuity, even your life insurance policy. So let's look at the exam tips. These are often called single premium immediate annuity, SPIA, because they can only be funded with a single premium. Of course, everyone should know that single premium immediate annuity means that it can be funded with single premium. You must begin paying benefit immediately. And within 12 months, you must collect the premium at least within 12 months, you must have started collecting it. Otherwise, within the first 30 days, you can start collecting your payouts. Or you can be careful not to do what? Over complicate exam questions. Immediate annuity is equal single premium. Income begins with the first year. Within the first year is equals immediate annuity. Please, anybody who doesn't understand this in a highlight? Immediate annuity is what? Single premium. Who does not understand that?
Okay.
Then income begin within the first year. Sorry. Yeah, Favor. I got it, Favor. Yeah, all right, thank you. Good night. Yeah, I love you. Bye-bye. Yeah. So immediate annuity is called single premium. Income begin within the first year is equals immediate annuity. So don't be confused. If you see it in the exam, they can twist it, they can make it confusing. If immediate annuity is equals single premium, income begins within the first year is equals immediate annuity. So if you see it, don't get confused. When they say immediate annuity, what they're talking about is single premium. When they say income begins within the first year, what they mean is immediate annuity. So in other words, they twist it, you see the same thing.
Excuse me, sir.
Uh-huh.
Can they also say within the first 30 days?
First 30 days is you can begin to collect the income within the first 30 days.
30 days to 1 year.
Huh?
30 days to 1 year, right?
No. 1 year is since you did a single premium, they are expecting you must start collecting the premium within 1 year. You must have collected your first income. But within 30 days, you can, if you like, within 30 days, it has matured for you to start collecting income. But however, the contract will mandate you that you must collect the first initial premium within 1 year. Is that clear?
Yes.
All right. So 30 days is that you can. First 1 year is that within the first 1 year, you must have initiated collecting your payouts. All right. So look at
immediate. You said immediate is single premium.
All right. I said immediate annuity is what?
It's single premium.
Equals to single premium.
Immediate annuity is called single premium. Whenever you hear immediate annuity, it means single premium, which means you can start collecting your income within 30 days, if you like. But however,
within 1 year.
Within the first 1 year, you must initiate collecting your premium. I mean, your income. Now, income begins what? Within the first 1 year. Is equals immediate annuity. So in other way they put it, just know is immediate annuity. They can call it immediate annuity is equals single premium, or income begins within the first 1 year is equals immediate annuity. Is that clear?
Yes.
Yes.
All right.
Yes, sir. Yes, sir. But sir, before you go forward,
Mhm.
I understood exactly what you said. But they can also decide if they want to defer it, right?
Of course, that is you, not
Yeah.
them.
Okay. Oh, yeah, okay.
Yeah, because when they initiate the contract, all this is what you're going to define on when you decide when you are starting when you're writing the contract, the accumulation and the annuitization. How do you want the annuitization? How do you want the accumulation? It's you that determines others. If you want a single premium, of course you must have the money to pay a single premium. Or you don't have money to pay a single premium, but you are sure that every month or every 2 months, every 3 months, you have social amount to pay into your annuity. You can still do that. Until in that way, if you're paying 1 month or 2 months or 3 months or 6 months or every year, you have the annuity will have accumulation period. But if you just pay a single premium, there is no accumulation period. Please do that one too. Single premium does not have accumulation period because immediately you pay it, your income stream will start. Now, deferred payments have accumulation period because you have social period to finish accumulation phase. All right. So, this is 924. This annuity is taking us 4 days, though. I hope everybody is enjoying it at least. But if we have gone to chapter 4, it would have been more better. But I think let's finish it up with her. So immediate annuity timeline. All right, look at immediate annuity. Look at this diagram. Everybody's seeing it. Everybody's seeing the diagram? So let's follow this diagram. That will help us understand it better. This is a contract established. You establish the contract. You decide that in your contract, you're going to pay a lump sum premium. A lump sum premium will be paid, which means you're paying one-time payment, which is what? Immediate annuity. You purchase the contract on day 0. On day 30, after the purchase, which is almost 30 days, your first income payment can start, if you like. Let's assume you like the first 30 days you collect. On the next 30 days, you continue to collect, which is a regular income. It now become a regular income. This is a second payment. On the first 90 days, yeah, per the payment schedule, you're going to collect
payment.
Principal plus interest. Ongoing payment, which means you have to, after every time, then the next one will be a year and day 120, which is every 30 days, which is every month. So single lump sum premium only. First payment must occur within 12 months of contract date. Did you see it?
Mm-hmm.
Ask the question. Did you see it? First payment must occur within 12 months of contract.
Yes, I see.
However, did you see it?
Yes, sir.
All right. So, however, the first 30 days, which is the 30, you can collect the money if you like. You understand? This one on the 30, you can collect the money. But you are mandated to have collect the first payment within
1 year.
Within the first 1 year. But the 30 days, 60 days on, 7 days on, they don't care about that. Whether you like collect it, whether you don't like collect it. But at least before 1 year, you must have collected your first payments. So that's become maybe for some people who may not need that money within that period, there is no need for you to go for it. However, you can decide that you do a single payment and you don't want immediate income. You can defer it. You can even say if it's a 5 years annuity, 10 years annuity, you have done a single payment, you don't want the annuitization to start immediately, you want it to start in 10 years' time. In that way, what do you think will happen?
They continue.
Annuity has been fully funded. You continue to get your interest. All right. So the deferred annuity, of course, unlike the immediate annuity, deferred annuity may be funded with any premium payment plan. You can do a deferred annuity using single premium, level premium, or what? Flexible premium. You can decide to do anything you want on it. Nobody bothers. So in as much as you can do immediate annuity, you can decide to say you don't want it to be annuitization to start immediately. You can decide that annuitization will be deferred as you prefer. If it's 10 years, you can decide, oh, I want my own to start 10 years when the annuitization is supposed to start. You can do that. So, but you know that when you defer it, you have more money, more interest.
Interest.
So that when you begin to collect, you are collecting the principal plus the interest.
Interest.
I want you to watch something on this one. Look at this drawing, the 0, the 30, the 60, the 90. Look at the payments. The 0, contract purchase, you purchase the contract on the 0. The 30 days after, first payment is what? You call it the first payment after purchase. Then this is the 60 after purchase. You collect a single premium. I mean, regular income. That is the second payment. Look at the 90 plus. Look at when per payment schedule, you are now collecting principal plus interest. Did you notice that? You are collecting principal plus the interest. Did you collect principal plus the interest on the 60?
No.
Did you collect on the 30?
Possibly, right? But we don't know.
No,
because it says
not you don't know. There was no interest on the 30.
Okay, because
there's none.
The time in between it was short.
Yeah. You don't collect any interest on the 30. You don't collect any interest on the 60. But on the 90, there is interest there. You are collecting your principal
because of the time.
Yeah. Then imagine when you say, I do not want to collect any payment. I will collect it when the policy is okay, which means, let's assume it's 10 years. We want to collect it in 10 years. The first collection will be interest plus interest because you must have accumulated more. So the more you leave your annuity, the more interest accumulation occurs. It's clear to everybody?
Yes.
All right. So deferred annuity, which means if you don't want to do immediate, you want to do defer. So immediate is opposite of defer. You defer, you accumulate more. So for deferred, when the owner decides to receive cash from the fund in the future, they have 3 options. When you decide to defer your annuity collection, you have 3 options. But remember, in immediate annuity, or when you pay a single premium, there is no accumulation period. Please know that. When you do a defer, there is always accumulation. So look at this. The 3 options you can use. 1, lump sum distribution. You want to start to collect one. Distribution is collection. You can do a lump sum. You want to collect the whole money once, of which the credited interest option is taxable. If you decide to say what you put on the contract is that you want a lump sum distribution, you want the money to pay you, you want to collect it once, the interest thereof will be taxable. Of course, you expect the interest to be taxed. It's not part of your money. The interest, is it part of your money? No. It's what you gain. That gain should be taxed. They're not going to tax you on the main money depending on where the source of the income. If it's come from your money you have paid tax on, they will not tax you on that. As far as the amortization period has reached, they will not tax you. Now, but however, they will tax the interest you accumulated because those interests has not been taxed. Now, systematic or periodic withdrawal taken from the accumulation account. If your money is still accumulating, you go there to collect money. You should expect a tax and even some penalty because the accumulation period is still on. Remember, amortization starts immediately after accumulation. Now, you break the law by going to collect your money because you're in need of money before the amortization starts. Then you should expect tax and penalty. Now, amortization, the conversion of the accumulation fund into a irrevocable structured income stream so as to receive guaranteed monthly payments. Which is the amortization? Amortization is when you start to collect the income. So let's look at the example. It's like we may stop today. I've added 1 hour 30 minutes. So example, get comfortable pulling apart the product name to answer exam questions. Always, it says you should get comfortable pulling apart the product name to answer exam questions. What does that mean? You should be able to know what a single premium deferred annuity is. You should be able to know what a flexible premium deferred annuity is. If you know it, there's no way you cannot pass annuity. You have to know all those terms we are talking about. That's why it's confusing. Starting from the classification, those 5 classifications, please know them well. The 5 classification is the 5 classification we are deliberating on. So if you know the 5 initial classification, all this thing we are saying will be easy for you to understand. My advice will be for those who are taking the exam and for those who the exam is next week, those who want this, particularly the person who want this chapter to be done for her, what you do is to go back, even like all this one we have done, go back and read them again on your own. Find a way you can do questions on them. I think that will expose you to more things. As we struggle to finish it up, we want to finish it up, but it's not going to be tonight. We want to finish it up. And it is a very large, large chapter. We will try to finish it up. It's delaying us from completing others. But however, let it be that all of us here are gaining from out of it now. So whenever we are in this, make sure you have your paper. Jot things down. Don't do as if you know all of them. Nobody has a electric brain. Or jot some things or some facts. Jot them down. That will help you. For instance, this exam tip, if I'm you, I'll just go through it and write some things down out of there. That will help you to do what? To remember it. To remember it. There are sometimes when I'm saying something, there are some things I will say, oh, please mark this in where this type of thing comes in exam. Make sure such a thing, just write it down. You just write it down, There's some things that you expect to see in the exam, even without telling you, that this is part of exam. And
Professor Bart, you said to focus on 5 things. What 5? Is it
Classifications.
the classification, we have passed the classification. We did
Oh,
it.
the classifications.
Yeah, the classification. Yeah. Just understand the classifications is very, very important. Understand, because based on the classification, that's why we are saying all this now. We are trying to expatiate on the classification. Each of the classifications, we are going through it. So know the basis. If you know the 5 classifications, it becomes so easy for you. So you can relate to it. All right. So definitely we're gonna stop here today, this night. We're gonna start in the morning, classification according to source of income. We're gonna start from it. I believe we may finish this annuity tomorrow. So we go back to our chapter 4. Then that of what again do you say you need? Is he here? Is it Chinyere or Chinanyere? What again?
Chinyere,
Chinyere, what do you say? Apart from annuity, what again? Dental.
Dental.
All right, I think that one is on another chapter. I think it's in chapter 8. I mean, chapter 10.
Okay.
That's chapter 10. It's in heads. So probably we're going to rush that one. But the most important one is annuity. Annuity is more broad.
And it's complex.
Huh?
It's very complex. Annuity,
Yeah, it's
very complex.
No, you're right. So we are trying to break it down as small as we can, as we can. But the best you can do is that lay hand on it and on your own time, read it. That will equally help. Find a question on them and answer. That will equally help you. It's not complex as you may think. It's just understanding the basis.
Now
And
you get 5 classifications.
Yes, immediately you get the 5 classification. Honestly,
those first classifications, if you understand it, this one is just like expanding it and expanding it.
Yes. It's the best. I said it's the first 5 classification is the root. You get the roots, the foundation. Then every other one, we are trying now to expand on the classification. That's what we are doing. So just go to the. So we're gonna stop here tonight. We assembly back tomorrow. Tomorrow is not gonna start by 7, please. It's going to start by 6 p.m. Please. So in the evening, it'll be 6 p.m. in the morning, 8:30. All right. So I think we stop here today. We start tomorrow morning by 8:30. All right. So good night, everybody.
Thank you so much.
Thank you so much.
Yeah, please
Thank you, sir.
read on your own. It's very important that you read your own. It helps. And again, prepare to be in Dallas by February 5th to February 7th. You're not gonna, if you miss it, you're gonna, oh my God, you're supposed to be here. Come and see people. Come and interact with people. You see, let me tell you, if you are following the millionaire, if you are following 5 millionaire, you are the next.
Amen.
No, that's the truth. The people you interact with determine what you become in this business. And even in our daily world, if you are with those who go out to be, they want to do extra job, you continue to do extra job. All through my days as working, I did not do extra job. I did not do extra time. No. So if the full time will not benefit you, then the extra time will not. So please try and book your ticket. Talk to somebody who introduces you to the business or your business partner. You have some of them will provide accommodation for you. Some of them provide accommodation for you. Yeah. And for those who are recruited directly to Dr. Ruth, talk to Dr. Ruth. He may help you out. But moreover, more especially, we want all of you to want to see you in Dallas. Come to Dallas, February 5th to February 2nd.